Hi everyone, this is Steve Elwell, Chief Investment Officer of Level Financial Advisors, and this is your second quarter market commentary. Uh, Nothing but interesting things happening in the second quarter. What a roller coaster ride it ended up being. If you just closed your eyes and I told you all the headlines that were going to happen in the second quarter of 2025, there is just no way you would believe the returns that I'm about to recap for how the stock market performed over those 3 months. So just to recap, we started the quarter with what might be the most volatile 2 week period we've seen in probably longer than even years, maybe even a decade, other than talking about COVID, I suppose. But the April kicked off with the Liberation Day on April 2nd, the announcement of not only higher tariffs than expected, but a wider range of tariffs applying to a wider range of countries, virtually every country, across the board, which was much, much, much worse than what Wall Street was expecting and pricing into the investment markets. Only to have a week later, all of those essentially put on pause for 90 days as the U.S. tries to negotiate trade deals with dozens and dozens of our major economic partners and hundreds of countries even above and beyond that, some of which we don't even do substantial trade with, which kind of makes you scratch your head as to why tariffs were even applied to some of those other countries. But nevertheless, as time went on, the market became less and less concerned that tariffs were going to have a major impact on corporate earnings and how the economy was growing. Trade deals were somewhat announced or further delayed and paused in terms of how the tariffs were going to apply. And so the stock market had this enormous V-shaped movement in the first month of the quarter where stocks lost from peak to trough almost 20% exactly on the S&P 500, which was one of the fastest 20% declines in history, only to fully recover and move above and beyond higher than that by the end of the quarter. And for investors, it was just a whipsaw of emotions as stocks plummeted and then stocks fully recovered. And so I'm going to show some charts that are going to visualize that and just sort of put it into context how good investors were not harmed by that, and those that were not quite as disciplined might have substantially been harmed if they acted on what would have been sort of panic in that downturn moment. So all in all, though, the U.S. stock market made 10.99% for the second quarter. International stocks continued to do even better, 12.05% for developed stocks. Emerging markets earned 11.99% for the quarter. Global real estate was positive also, although not to the same degree as the U.S. stock market, up 2.74%. And even the bond market had a positive quarter, up 1.21% within the U.S. and 1.93% outside of the U.S. And one of the things that I want to show before we fully get into exactly what happened in that downturn is just a reminder that even when the downturns happen, which they do happen, they're an inevitable part of investing in the stock market, that the positive periods more than make up for those scary moments when stocks go down, even if they stay down for a relatively long period of time. So this is a visual about bull and bear markets. So as a reminder, a bull market is when stocks are doing well, and a bear market is when stocks are going down in value. Just a reminder at all sorts of different periods where there were downturns in the stock market, and how long the downturns lasted, and how long the subsequent bull markets lasted after the downturn. And so visually, this shows essentially 7 different downturns. So stagflation from the 70s, the Volcker tightening when inflation was spiking in the 80s and the Federal Reserve governor decided that they were going to dramatically raise interest rates to try and control inflation, and that caused a little bit of chaos in the stock market. The 1987 Black Monday, the famous Black Monday, which was a terrible day for the stock market and continued on to be a terrible quarter for the stock market. The tech bubble bursting from 2000. We all remember the global financial crisis from 2007, 2008. The COVID pandemic from 2020, which was a brief downturn but quite dramatic. And then the 2022 inflation spike, which ultimately resulted in the Federal Reserve again dramatically raising interest rates, which caused some havoc in both the stock market and the bond markets. And what you can see on the part of the bear markets where the downturn shows, it shows just in terms of how long in months those downturns lasted. And then subsequently, the same color line above that middle part of the line, showing the bull market representing how long those bull markets lasted after the recovery had happened from the downturn. And it's very, very clear that in the majority of instances, the bull markets were much, much longer, and the returns far outweighed the decline that happened in the previous bear market. So if you want to average these out, which this little box on the middle right shows, the average bull market was 70 months long, and the average cumulative return 221%. Several of the bull markets were much, much larger than that even. If you look at the light blue line and the dark blue line, which is Black Monday and the crisis from 2007, 2008, they lasted a very long period of time, much longer than average. And their total returns cumulatively, I mean, you're talking about the total returns after the global financial crisis are over 400% until the next bear market. And same with the Black Monday returns that came, which ultimately is really what the 90s look like. But fantastic returns from late 80s into early 90s. And so really just a point of showing this is sometimes what we'll hear when there's a bear market is we'll hear, oh my gosh, this is going to last forever. And then even if it recovers, it's going to take a really long time for things to recover and make all this up. And that's really not the reality of how the average bear market happens. The average bear market lasts a little longer. In this chart is showing a little longer than a year, but the average bull market is more like 4 or 5 years. And if the total cumulative return in the bull markets is over 200% in this example, whereas the bear market was just a decline, and don't get me wrong, it's not a small decline, but 38% is the decline. So the big picture story is, if you stick with investing, even through the downturns, the money you make in the good years, which happen more often than the down years, the money you make in the good years ends up being cumulatively much, much more than what you lose when those bad years do show up. So this is a nice visualization and reminder that the good years tend to be much bigger and last a lot longer than the bad years. But if we specifically go into what happened in the first 6 months of this year, I love this visual from Avantis, which is a great investment company that we do some work with. And this shows multiple different data points. I'll start on the left. This is referencing the S&P 500. That the worst day of the year was on April 4th. The S&P 500 went down 5.96% that day. But the best day was only 5 days later, where the stock market gained 9.52%. Imagine if you had made a really difficult, painful, emotional decision regarding your portfolio where you sold during that downturn in the first week of April, only to see a 9.52% positive day on April 9th. It would be absolutely crushing to watch the stock market recover that quickly after you had just exited because you were nervous about what was going on. It doesn't mean it was easy to stick with it. And looking backwards, obviously we're using hindsight to say, of course you should have just stuck with it. But in the moment, the markets were reflecting to new information that was unexpected and was worse than expected to be based on the amount of tariffs that were announced. Even during all this 6-month time frame, there was 9 new all-time highs in the S&P 500. 60% of trading days were positive, 40% were negative, and the VIX, which is a measure of volatility, had some very substantial numbers hit in the first week of April. Hit 52 on April 8th, which for context, 10, 15, 20 would be what might consider to be normal volatility. 52 is some craziness is happening and stocks are going all over the place. So very uncomfortable April for the investment markets. And then if we separate out by the positive part of the trading year, the first 6 months, and the negative part, if you go from the first 32 trading days of the year, so January 1st through February 19th, where essentially the S&P 500 hit a new all-time high on February 19th, S&P 500 was up 4.6% over that time frame. And then from February 20th through April 8th, the next 34 days, lost 18.7%, which is a dramatic downturn for 34 days, only to earn 24.9% over the next 56 days from April 9th all the way through June 30th. I mean, when we say the second quarter was a wild ride, nothing defines it better than those two bar charts there on the right for showing essentially February 20th through June 30th. That is the definition of whipsaw in the investment markets. And it is difficult to stick with it during those type of market experiences. But unfortunately, they do tend to happen. They don't happen all the time, but they do tend to happen. And as hard as it is to do, staying in your seat is almost always the right choice for long-term investors. If you have a short-term horizon for your investments, you maybe shouldn't have been in the stock market at all. And so what I really mean by that is if you're going to spend your money in the next 6 months or 1 year or 18 months, then you probably shouldn't have been investing in the stock market to begin with, because there's no guarantee that things are going to work out over that short of a time frame. But if you're investing 5 years, 10 years, 20 years over the course of a normal retirement, sticking with it even through those type of downturns, as difficult it is just about always the right thing to do, because things like this happen, especially when the markets get extra volatile. The worst days and best days tend to be lumped together because the investment markets collectively, investors collectively, are trying to figure out what's going on and what does this information mean. How will it translate to next quarter's profits, next year's profits, how the economy may grow? What we know now is that a lot of those tariffs were rescinded or paused, that some trade deals have been negotiated, tariff levels have been generally in aggregate reduced, and the impact ultimately wasn't as much as what the investment markets initially thought it might be. On top of that, corporate earnings have been better than expected. Inflation has remained relatively tame. Interest rate cuts might be coming later in the year. And the economy has rebounded and continued to grow in the second quarter from the looks of it. And so when you digest all of that, then the markets sort of came back to the realization that, oh, this isn't really quite as dramatic as we thought it was going to be. Things are still okay. And I would also add, while I don't have any visual to show this, the continued investment in artificial intelligence and the productivity gains that are starting to show up with companies using artificial intelligence has become a big part of what's happening in the investment markets. There is real optimism that these investments are going to pay off for companies that are focusing on it, with the reality that it's feasible that a lot of publicly traded companies are going to gain productivity based on these investments that will potentially translate into better profit margins. If they're able to do more with less or do more with the same, you may see, or we might be in the moment of where we're seeing the type of productivity gains that translate into great stock market returns and great corporate profit earnings reports, like we saw in the 90s as computers became a bigger part of the office. I'm not sitting here guaranteeing that that's going to come to reality or fruition, but there is a lot of optimism that this may be a sizable leap forward in productivity. And don't get me wrong, every year, every company is trying to get more productive, a little bit more efficient, to be able to do more with the same or do more with less. So it's not as if that slow rolling productivity gain train doesn't always happen. It is always happening. But the technology that even we're starting to see within our own business is very powerful. There really is no doubt that there is going to be time saved from using tools that are just smarter, tools that simply just work better. And I think anybody that maybe has done like a Google search versus a ChatGPT search, as a simple example, can start to realize just what the difference is in terms of just how smart some of these language learning models are. LLMs is what, the abbreviation that some people use. But the ChatGPTs of the world that ultimately are providing better results and better information for the most part than what you would get in a normal search engine. So the hope is that a lot of companies use that technology to get a little bit better. And there's investor optimism around that. One other thing that I want to touch base on as the stock markets hit new all-time highs and ended June basically at an all-time high or pretty much right there, is that a lot of times what we hear from investors is, well, boy, the stock market is overpriced or it's at the highest price of all time. Investing cash right now is not a good idea. Or maybe it's a bad time to do that. I'll wait for lower prices so I can get a better deal or a better entry point. And unfortunately, there just isn't any data to support that. So what I mean by that is this visual from our friends over at Dimensional Fund Advisors does a great job of showing over the last 100 years, so 1926 to 2024, after months that ended at a record high, compared to months that ended at any other level, or any level in general, what are the 1-year returns, 3-year returns, and 5-year returns on average? And what it tells us that actually, when the stock market ends at a record high, the average 1-year return is actually better than what it would be for any period in general. So the 1-year returns after stock market ends at a record high on average were 13.7%. The 1-year return after months that ended at any level, the average was 12.5. Even when you look out 3 years or 5 years later, the returns are virtually the same. So whether you were investing when markets were at an all-time high or whether they were at any level at all, whether it's an all-time high or anything less than that, the return expectation and the return reality on average is actually either the same or slightly better, depending on whether you're looking at 1 year, 3 years, or 5 years. And so what that really tells us is stocks are always priced to deliver positive expected returns. So when investing at record highs, that doesn't change that. And so in terms of pausing investing cash or waiting for a downturn, the opportunity risk of what you might miss out on by waiting for a downturn that may not come for months or years is generally a negative. If you end up sitting there saying, I'm just going to wait for a downturn, you are probably going to cost yourself money. That's no guarantee, but the reality is when we look at data from the past 100 years, there's really no evidence that tells us that you should wait if stocks are at an all-time high to invest at a different time in the future. And so we like to show that because I kind of hear that a lot in terms of where stock prices are. I hear things like, this can't last, this doesn't make sense, stocks are overpriced. But, I mean, as funny as it is to say, something like, 80 or 90% of my 18 years doing this, stocks have been within 5% of all-time highs. You really only think about the periods where major downturns happened where stocks were not near their all-time highs, right? This past April, around the first week of April, spring and summer of 2022 when that downturn happened, March of 2020 when COVID first started, December 2018, all the way back to the great financial crisis of 2008. But other than that, once markets fully recovered, they chugged their way higher from all-time high prices to new all-time high prices. And if you sat in, let's say it's 2011 and stocks hit a new all-time high after recovering from the 2008 crisis. If you sat there and said, well, oh no, stocks are at an all-time high, I'm going to wait for the next moment that prices are 10% or 15% lower, you might have waited years. And the cumulative return that you missed out on, even if that 10% decline happened, still ended up resulting in a huge negative for you. So as an example, if stocks gained 30% over the next 2 years, but then lost 10%, you're still not getting a better price than what you would have gotten if you had just invested on day one when they hit that all-time high. So it's just sort of reiterating what the data tells us, which is if stocks are an all-time high, it's no reason to believe that some downturn's about to happen or that stock returns are about to be below average. So with that, that's a recap for the second quarter, which again was a volatile one, but kudos to everybody who stuck with it during the volatility, who didn't panic, who trusted the process, who stuck with their investment plan. Good investors with good behavior get good returns. That is the reality economically from investing in the stock market. If you stay disciplined, you will get reasonable stock market returns even when the bumps happen. And so with that, I'm Steve Elwell, Chief Investment Officer of Level Financial Advisors, and we'll talk to you again next quarter.